Today is the 20th of March 2021. My name is David Hickson, and in today's market update I'm going to be speaking about the shapes of cycles, one of my favorite subjects. Before we do that, I must ask you to please make sure that you have read and understood these disclaimers. So here is a chart of the S&P 500. This is the analysis that we've been looking at for many months now. And as you can see, here is the 20-week cycle trough, which I spoke about in last week's video. And so this is the slightly bigger picture that we're looking at here. Now, the reason that I wanted to speak about the shapes of cycles is because there can be a tendency for me to focus on the smaller detail and not really perhaps present the entire picture, and that's really what I would like to do in this video. So what do I mean about the shapes of the cycles? Well, it is a subject that I am very interested in because, of course, the result of the fact that we have these cycles that are influencing the prices of the financial markets is that certain shapes form in the charts. And it is not a new idea. It is obviously at the basis of most classical technical analysis, in that you're looking at the patterns that are formed. So let's speak about the kinds of shapes that these cycles are making. And in particular, I am going to focus on the 20-week cycle. And the reason for that is because, as you know from last week's video, we are expecting the market to move down into an 18-month cycle trough, which is expected a little after the middle of this year. And we have just witnessed the trough of a 20-week cycle over here at the beginning of March. And so we are in this last 20-week cycle. And so the question is, what do we expect out of this 20-week cycle? What is the shape of this cycle going to be? Because if we have an understanding of what the shape is going to be, then we will be better equipped to be able to trade all of the moves within that particular cycle. So let's have a look at the four most recent 20-week cycles, or I should say the four 20-week cycles that make up the current 18-month cycle. And so we are starting here in March of 2020 with the trough of probably 54-month magnitude, maybe an even longer cycle formed that trough in March of 2020. And the 20-week cycles that we have seen since then have been this one over here, number one, number two, number three, and now, of course, we are in the fourth 20-week cycle, which will take us down into the 18-month cycle trough expected later this year. And in fact, if I display the phasing analysis using semicircles, you can actually see those cycles more clearly because they are color-coded. And so here is the first 20-week cycle, here is the second and the third, and this is the fourth one that we are currently in at the moment. So what do I mean by the shapes of these cycles? Well, let me show you. The combination of cycles that influence the price movements of financial markets end up creating M shapes in stock markets because of the fact that the cycles are synchronized at their troughs. When you're looking at an instrument that has synchronized peaks, then of course you end up with a W shape, but let's focus just on this market for today. And let's look at the M shape of the first 20-week cycle, which started here and it ended over here, according to this analysis. And so the M shape consists of a move up to the first peak, then a move down to the 80-day cycle trough over there, then a move up to the second peak, and then a move down to the final trough. You can see the very distorted M shape that took place there. Now, it is distorted because it is a very bullish cycle. And so when I'm speaking about the shape that is created in the market, I'm not simply speaking about the M shape, because we know it's going to be an M shape, but it is a matter of whether it's going to be a bullish M shape or a bearish M shape or a neutral M shape. This was a very bullish M shape. How do we determine that it is bullish? I tend to speak about bullishness as a fairly general concept, but in fact we can define it a little more accurately. And there are various ways that we do that. I'm going to quickly go through them here because it's an important part of the discussion. The first way of determining how bullish or bearish a particular cycle shape is to work out how much that full cycle has moved price up or down. All right. If it has moved price up, in other words, if it completes the 20-week cycle at a higher level than the level at which it started that 20-week cycle, then it has, by definition, been a bullish cycle. There are various ways of measuring this, and I'm going to show you a couple of them now. One of the ways of measuring it is to measure the full extent of the price move during the course of this cycle, and then to work out how much of the cycle was retraced as price came down into that trough, and then to express that as a percentage. So I would give that cycle a rating of about 75%, okay, because it traveled all the way up from the opening price of the cycle to the highest price of the cycle, which would represent 100%, and the result where it ended gives us a bullishness rating, if you like, of 75%. But now, because these cycles elapse in time, the time element is also an important way of determining how bullish or bearish a cycle was. So let me show you that. What we do is we measure the time from the start of the cycle to the end of the cycle, okay, and we then work out where the highest price was. This was the highest price over here. And again, the start position is 0%, the end position is 100%, and so we work out at what point the peak in terms of price actually formed in that cycle. So I would estimate that to be about 85% perhaps. Of course, you could build up a spreadsheet and you could work out these numbers very carefully. And in fact, it's a part of the analysis process that Sentient Trader performs, is it works out the bullishness or bearishness of every single cycle in the analysis. And it's one of the things that takes it quite a long time to perform an analysis, is because it's working out all of these calculations in terms of gauging the accuracy of the analysis that it is performing. But I'm not going to bother with spreadsheets in this video. All I'm going to do is provide an approximate rating for this cycle. It was 75% to 85% in terms of its bullishness. Let's look at our second 20-week cycle, which climbed up to a first peak over here, came down to the 80-day cycle trough over here, up to the second peak, and then finished its cycle over there. So again, we can calculate the bullishness in terms of the price move, and you can see this cycle actually retraced more than 50% of the move up. So I would give that probably, let's be generous and give it a 40% rating. And in terms of time, we measure from the start of the cycle to the end of the cycle, and where was the peak? It was over here, which looks as if though it was perhaps just a little over halfway, so I'll give that a 55% rating. You can see that the first cycle, the first 20-week cycle, was very bullish. We've rated it 75 to 85%. It was clearly a bullish cycle. The second cycle is much less bullish. It is still a bullish cycle because price ended that cycle wave higher than it started, so by definition it is bullish. But it was only a 40% to 55% bullish cycle. So let's speak about that for a moment. Why do we have this progression from a bullish cycle to a less bullish cycle? We expect that. It is something that happens all the time. And in order to understand that, let's take a look at our semicircles again. The semicircles are a very useful way of understanding the influence of each one of these cycles. So looking at this period of time during the first 20-week cycle, you can see that the 40-week cycle was moving up. Can you see this pale green line here? It is moving up. Okay, and in fact one could draw a vector. I'm not going to mess up this diagram, perhaps we'll do that a little bit later. You could draw a vector across the semicircle to give a rough idea of the influence of each one of these cycles. The 18-month cycle is also moving up, and the 54-month cycle is also moving up. And so The cycles longer than the 20-week cycle, or at least the 3 cycles longer than the 20-week cycle, are pushing upwards. The result will be a bullish cycle shape. Now, what happened with the second 20-week cycle over here? Why is this not as bullish? The 18-month cycle is still moving up, and the 54-month cycle is also still moving up. But what changed? What changed was this 40-week cycle over here, which you can see was actually moving downwards. Now, the fact that it is the next longer cycle than the 20-week cycle is very important, because generally the cycles that are closest to one another in terms of the nominal model that we use to analyze the markets, the cycles that are closest together tend to have more influence on the cycles beneath them. And so the 40-week cycle, although it is a shorter cycle than the 18-month cycle and might seem to be less impressive or less important, have a lower amplitude, it nevertheless does have a greater effect on the 20-week cycle because of its proximity to that cycle in the nominal model. And so it is not surprising that the second 20-week cycle is less bullish than the first 20-week cycle. Let's turn those semicircles off and take a look at the third 20-week cycle, which was this one over here. Again, price rose up to its first peak. It was very difficult to identify an 80-day cycle trough, as you will probably know from watching these videos, but that was probably the position of the 80-day cycle trough. And then price rose up to the second peak of the 20-week cycle and finally came down to the final trough of that 20-week cycle. Again, we have a bullish cycle, clearly, because price completed the wave at a higher level than it started it. What would you give that rating? I would say perhaps about 70%. Perhaps I'm being generous, maybe 65, but let's call it 70% for now. And in terms of the position of the peak occurred late over there, so I would give that another 85%. Maybe it should be 90, but let's call it 85. So again, we had another bullish cycle. So you might imagine that as we step through the cycles on the way to this 18-month cycle trough, that the bullishness that was caused by this big magnitude trough in March of 2020 would gradually fade. But of course it doesn't work like that because of all the shorter cycles that are bouncing up and down. And so you don't have a sequence of bullishness, if you like, that gradually fades over that period of time. In fact, we expected this cycle to be more bullish than the previous one. In other words, the third 20-week cycle was expected to be more bullish than the second 20-week cycle. Why was that? Let's turn again to our semicircles. And I have already explained the fact that the 40-week cycle is very important in terms of the cycle shape that we expect from the 20-week cycle because of its proximity in the nominal model. And so if we draw a vector over the 40-week cycle semicircle, it's a real approximation, don't take that too seriously, but it certainly shows us that the 40-week cycle was influencing prices to rise. In other words, it was bullish. And the fact that the 40-week cycle was bullish means that we expect a bullish shape in the 20-week cycle during this period of time. I hope that makes sense. So let's get to the point of this video, which is really to discuss what we are expecting now. So before I turn these semicircles off, let's speak about what these cycles are doing. We're considering the shape of the fourth 20-week cycle over here, which is going to carry us down to the 18-month cycle trough. So what are the longer cycles doing? Well, the 40-week cycle, as you can see, is influencing price to move downwards, and the 18-month cycle is influencing price to move downwards. And so both of those cycles combined are likely to give us the most bearish shaped cycle that we have seen since March of 2020. I hope that makes sense. Of these 4 cycle shapes that we are considering, the fourth one is definitely going to be the most bearish. It doesn't necessarily mean that it is going to be a bearish cycle, but it probably will be. All that we can say for certain is that it will be the most bearish of these 4 20-week cycles. So let's turn those semicircles off again and consider very roughly what we are expecting. price has bounced out of this 20-week cycle trough and it is going to reach its first peak. Is it possible that its first peak has already formed? Well, let's think about where we expect that peak to form. Remember, I've said this is going to be the most bearish of the cycles that we've seen since March 2020. And so far, the most bearish cycle had a peak that occurred at the 55% mark, roughly. So where do we expect the peak of this cycle? Well, we would expect it before that. In other words, we would expect it within the first half of the cycle. Is it possible that the peak formed in this past week? It is possible. That would be a very early peak, but it is possible. So we are expecting an early peak, and then price is going to come down into the 80-day cycle trough. Then it's going to bounce up again. Is it likely to achieve a higher peak? No, because of course we are expecting an early peak, and so therefore the highest peak should occur in the first half of the cycle. And then price is going to turn down and come down into this 18-month cycle trough. It is probably going to end up being a bearish cycle. In other words, it will probably end up at a lower level than the 20-week cycle trough formed at the beginning of March, but not necessarily. It could still be an ever so slightly bullish cycle or a neutral shaped cycle. So that is our expectation. Now, let me clear all of that and show you something else, the composite model line. You must remember that the composite model line is really just another way of visualizing the implications of the analysis. It takes all of the information in that analysis, recombines it, and presents it on the chart. And so what is the composite model line telling us to expect? It is telling us to expect that price is now bouncing out of the 20-week cycle trough. We're going to come down into a 40-day trough. And then we're going to achieve a peak over here. And that peak will indeed be within the first half of this cycle. Then price will come down into the 80-day cycle trough. Then it will come up and not achieve a higher peak. And then it will come down into an 18-month cycle trough. Now you will notice that according to the composite model line, it is not expected to come down very far. In fact, it would seem to imply that we're going to have an ever so slightly bullish 20-week cycle over here, with price not actually dropping below that level. But one of the reasons for that is because I have included something called sigma L in this composite model line. Sigma L is the sum of all the longer cycles, longer than the longest cycle found in this analysis. And so the longest cycle found in this particular analysis is the 9-year cycle. And so sigma L represents all of those much longer cycles that are all contributing to what is happening in the markets. I can turn sigma L off in the composite model line, and that is the result. Now, I could spend a long time explaining all the details behind, why this has happened, but the important points to notice are that according to the analysis without a consideration of sigma L, we were expecting a much more bullish and quicker move out of this 54-month cycle trough. And in terms of the cycle shapes that we're discussing today, you can see that the composite model line without sigma L expected really a much more bullish first 20-week cycle. It expected a slightly bearish second 20-week cycle. The third 20-week cycle was not very different, although it expected it to come down a little bit further. But here is the important point. Even without sigma L, we are getting a very similar shape in terms of what we are expecting for the next 20-week cycle. The only difference is that it will definitely be a bearish cycle, and it will not be a fairly neutral cycle, as was the implication when we included sigma L in the composite model line. So what is happening now? Well, price has come down to the 20-day FLD, which, as you know, is a very important moment. After the formation of the 20-week cycle trough at the beginning of March, we had our A category interaction where price crossed up above the FLD. Interestingly, it failed to reach its target. The target I discussed in last week's video, and it was pretty much over 4,000, and so price didn't quite get there. It almost got there, but it didn't quite. Does that mean anything? Yes, it might indicate that in fact this market is beginning to turn a little bit bearish because it failed to achieve that target. And the A category target is almost always achieved unless the market is turning bearish. The next thing that happens after either fulfilling or failing to fulfill the target of the A category interaction with the 20-day FLD is the price will come back down to the 20-day FLD, where it is expected to find support at the level of the 20-day FLD at about the time that the 20-day cycle trough forms. So now you can see our nest of lows here for the 20-day cycle, and so in fact Friday's low is a very good candidate for the 20-day cycle to form. But as you can see, it slipped a little bit below that 20-day FLD. It hasn't broken clearly through it yet, but it certainly didn't find support at a level above the 20-day FLD, which would have indicated that the market was still strongly bullish, and it is something that we have seen time and again over the past almost a year now. We've seen price failing to actually come down to that 20-day FLD because of the bullishness in the market. And so the fact that it has come down to the level of the 20-day FLD and slipped below it is a second indication that we are getting some bearishness coming into this market. I am still expecting the market to find some support at the level of the FLD. However, as I've spent most of this video explaining, we are expecting a bearish cycle. It is quite possible that this peak is already the peak of the 20-week cycle. I am probably expecting another move, perhaps even to a slightly higher peak, or maybe not, but we'd certainly expect a little bit of a bounce up here before price comes down into the 40-day cycle trough. But the signs are definitely beginning to appear of some bearishness in this market. I do hope that you found this market update interesting and useful. If you have any questions, please put them in the comments below the video. I look forward to hearing from you.